Hey everyone, welcome back to Corporate Decoder, the place where we shine a light on the truth behind the numbers. Today we're diving into what looks like a routine update, but might just hold a few surprises before we start. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below. The place to get more in-depth discussions. Alright, let's break down this report. It's an 8K filing, which usually means something significant has happened. This particular filing from Bruker Corporation is dated the 12th of January 26, and it's giving us a peek at their recent performance and their outlook for the future. Think of it as an early heads up from the company before their official, more detailed reports come out. So what's the big news? Bruker was at the 44th annual JP Morgan Healthcare Conference, and they shared some preliminary thoughts on their financial performance. They're giving us expectations for revenue in the fourth quarter of 2025, which ended on the 31st of December. They are expecting revenue to be between $965 million and $970 million. That's a pretty specific range, so they seem quite confident in those numbers, at least at this preliminary stage. On top of that, they mentioned that their Bruker Scientific Instruments segments had a book-to-bill ratio above 1.0 for the fourth quarter of 2025. Now, what does that mean? A book-to-bill ratio is a way to measure demand. If it's above 1.0, it means they received more orders or bookings than they were able to fulfill or bill in that period. This is generally a good sign, suggesting future revenue is expected to grow because There's more work coming in than they can handle right now. It indicates healthy demand for their products and services in that segment. But they didn't stop there. They also gave us a preliminary outlook for the entire year ending the 31st of December 2026. This is where things get interesting because it's about future growth. They are projecting organic revenue growth of flat to up low single digits. That means the revenue from their core businesses, excluding any acquisitions or sales of assets, will likely stay about the same or grow a little bit. They are also expecting their non-GAAP operating margins to expand by 250 to 300 basis points. That sounds technical, but it essentially means their profitability is expected to improve. A basis point is 1/100%, so they're looking at a 5 to 3% jump in how much profit they make from their operations, and the cherry on top, they anticipate non-GAAP earnings per S-share to grow in the double digits. That means the profit attributable to each share of their stock is expected to increase by 10% or more. These are all compared to their full year 2025 results. Now, it's super important to remember that these are preliminary numbers. The company itself stresses this in the report. They haven't finalized or audited their financial statements for 2025 yet. So while these are their current expectations, the final numbers could be different. They're basically saying don't bet your house on these exact figures just yet. They also point out that important information might pop up on their website, so it is always a good idea to keep an eye on their investor relations page. Let's look at what is listed on the stock exchange. Bruker Corporation has its common stock trading under the ticker symbol Bruker on the NASDAQ Global Select Market. They also have a special kind of stock, their 6.375% mandatory convertible preferred stock Series A. Trading as Bruker P, this preferred stock is interesting because it is designed to convert into a set number of common shares by a specific date, which is the 12th of January 2026, fitting perfectly with the date of this report. This suggests that this conversion might be happening right around now, which can sometimes affect the supply of common stock and potentially its price. As we saw, they are talking about non-GAAP numbers. What does that mean? GAAP stands for Generally Accepted Accounting Principles, which are the standard rules for how companies report their finances in the United States. Non-GAAP measures are adjustments made by the company to present a clearer picture of their ongoing business performance by excluding certain items that they believe might distort the results. For example, they might exclude one-time expenses from restructuring or gains or losses from selling assets. The company states they can't provide a precise reconciliation for these forward-looking non-GAAP measures, like operating margin and earnings per S-share, because predicting those excluded items without unreasonable effort is just too difficult. This is pretty common, but it means investors need to do their homework to understand what exactly is being included and excluded. The report includes a pretty standard cautionary note regarding forward-looking statements. This is basically a legal disclaimer designed to protect the company. They're saying that any statements about the future, like their expected growth, performance, or business outlook, are just predictions based on current information. They caution that actual results could be very different due to various risks and uncertainties. They list a bunch of potential issues like market volatility, currency exchange rate fluctuations, competition, and even losing key personnel. They also mention that more detailed risk factors can be found in their other filings with the Securities and Exchange Commission. This is just good practice for any public company to ensure they are not making guarantees about the future. Let's revisit that book-to-bill ratio. The report clarifies that this is an operational measure, not a financial one that requires reconciliation under SACE rules. They define it as the ratio of net bookings to reported revenue for the same period. This distinction is mostly for regulatory purposes, but it emphasizes that while it's a useful indicator of demand and future revenue potential, it's not a direct financial statement metric like profit or revenue. Now, looking at these numbers and what Bruker is telling us, here is my take. The company seems to be in a pretty solid spot, especially with that book-to-bill ratio being above 1.0. It signals strong demand, which is always a good sign for a business. The projected growth in operating margins and earnings per share for 2026 suggests they are not just expecting to grow, but to become more efficient and profitable as they do. This is the kind of forward-looking statement that investors love to see. However, we have to keep in mind the caveats. These are preliminary estimates. The financial world can be unpredictable and things can change. They've also listed a broad range of risks from market volatility to currency swings, which are real concerns for any global company. The conversion of their preferred stock around the same time as this report could also be a factor to watch for common stockholders. Overall, Bruker appears to be navigating the market with a degree of confidence, projecting growth and improved profitability. The focus on scientific instruments and their strong bookings in that segment are definitely highlights. The key will be how they execute on these plans and manage the risks they've identified. Alright, that is our breakdown of Bruker's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description to continue the conversation. Thanks for watching. See you next time.